Why do some great companies, strong, enduring, and profitable, trade in the market for less than the value of their own assets? Why does the market sometimes punish success and reward speculation? And why do moments of panic or neglect create some of the best opportunities an investor will ever see? This paradox, the tension between price and value, sits at the heart of intelligent investing. It's a simple concept on the surface, but as Benjamin Graham taught, its implications run deep into human psychology, economics, and the very way markets function. Merely a century ago, Graham asked a question that still haunts investors today. If a business is worth $1 on paper, why would the market sell it for 50 cents? To him, that was not a mystery, it was an invitation. Because behind every such discrepancy lay one of two things, either a business truly in decline or a moment of temporary misjudgment by the market. And it was in that space, between perception and reality, between fear and fact, that Graham built his philosophy. He realized that markets do not always reflect the truth. Prices, he wrote, are set by the voting machine of emotion, by optimism, fear, and fashion. But over time, reality asserts itself. The weighing machine of value takes over. And those who can tell the difference between what is popular and what is sound, between market price and book value, stand to benefit not from luck, but from understanding. Today, the same paradox persists. We see companies with strong assets, clean balance sheets, and consistent profits trading at prices that make no sense. We see others with no earnings, no assets, only a story, trading at record highs. The question remains as relevant now as it was in 1934. What should the intelligent investor believe, the market or the numbers? To answer that, we must step back into Graham's world. The years after the Great Depression, when the very idea of valuation was being rebuilt from the ground up. Because it was there, amid the ruins of speculation, that Benjamin Graham first uncovered the quiet power hidden in the gap between book value and market price. The year was 1932. America was reeling from the Great Depression. Banks had failed, fortunes had vanished, and the once booming stock market lay in ruins. The roaring optimism of the 1920s had given way to silence, a silence filled with disbelief, fear, and shame. In that silence stood a man named Benjamin Graham. Once a rising Wall Street analyst, now a humbled observer of human folly. He had seen firsthand how markets, driven by speculation, could lose touch with reality, how they could price dreams as if they were facts, and facts as if they were worthless. But instead of retreating from the wreckage, Graham began to study it. He opened the balance sheets of fallen companies, dusty ledgers filled with numbers long ignored, and discovered something remarkable. He found businesses trading in the market for less than the value of their cash, receivables, and inventory, less than what an owner would receive if the company were liquidated entirely. In other words, Wall Street was selling entire businesses for less than the value of their parts. To most, it was a market in chaos. To Graham, it was a field of opportunity. He called these anomalies bargain issues, or later, net stocks, securities so cheap that even in the worst of times, an investor could hardly lose. It was the birth of a new kind of investing, one not based on prediction or emotion, but on facts and mathematics. In his 1934 masterpiece, Security Analysis, co-written with David Dodd, Graham captured this insight. The investor is neither right nor wrong because others agree or disagree with him. He is right because his facts and reasoning are right. This statement was radical in an age when speculation was the norm. It meant that truth in investing was not determined by consensus, but by evidence. And evidence, Graham found, often pointed to one thing: that the market regularly mispriced reality. His discovery was both simple and profound. When emotion drives markets, value hides in plain sight. That realization changed his life and eventually the course of investing itself. Because from that moment onward, Graham stopped chasing prices and started measuring them against something real: book value, the company's tangible worth. And what he found revealed one of the most reliable ways to identify undervalued stocks, not through forecasts or sentiment, but through the quiet certainty of arithmetic. To understand Graham's insight, we must begin with two simple but powerful ideas: book value and market price. They sound alike. Both seem to measure what a business is worth, yet they come from entirely different worlds. Book value is the accountant's view of a company. It represents what would be left if all its assets were sold and all its debts were paid. In essence, it is the net worth of a business, the amount that belongs to shareholders on paper. Market price, on the other hand, is the crowd's opinion. It is what investors are willing to pay at a given moment, a reflection not of reality, but of perception. And as Graham discovered, these two numbers rarely agree. A company might have assets worth $100 million and debts of $40 million, giving it a book value of $60 million. But if fear grips the market, investors may value that same business at only $40 million or less. In that moment, the market price falls below book value, and the patient, rational investor is presented with an opportunity. To Graham, this wasn't a matter of cleverness, it was a matter of arithmetic. When the price of a business fell below what it was truly worth, the risk declined and the potential reward rose. That was the beginning of value investing, not as a philosophy of optimism, but as a discipline of realism. Graham knew that markets were emotional, and emotions could distort logic. In his words, "The market is there to serve you, not to guide you." The intelligent investor, therefore, does not follow the market's mood, he uses it. When others are fearful and prices fall below intrinsic worth, he buys. When optimism inflates values beyond reason, he sells or abstains. But this idea, so calm, so methodical, requires one skill above all others: the ability to think independently. Because when the crowd sees a stock price dropping, it sees danger. Graham saw something else: a mispricing waiting to be corrected. That difference, between reacting emotionally and reasoning logically, is what separates speculation from investment. And so, understanding book value is not merely about numbers on a balance sheet. It's about developing a mindset, one that measures worth not by popularity, but by substance. Yet Graham also warned that not every cheap stock is truly undervalued. Some are cheap for good reason, because the business itself is deteriorating or poorly managed. So how did he separate true bargains from financial mirages? The answer lies in his method: a systematic approach to distinguishing value from danger. Benjamin Graham was not a man who trusted appearances. He trusted evidence. For him, an undervalued stock wasn't defined by how low its price had fallen, but by how sound the underlying business remained.
He would begin, always, with the balance sheet, the foundation of his analysis. If a company's current assets, cash, receivables, inventory, exceeded all its liabilities, he knew there was a base of tangible value. If that company also had manageable debt, consistent earnings, and a record of paying dividends, Graham would take notice, because together those signs pointed to something rare, a margin of safety. That phrase, margin of safety, became the cornerstone of his philosophy. It meant never relying on perfection, never assuming the market will agree with you tomorrow, and never buying an asset unless its real worth stands clearly above its current price. To quantify this, Graham developed what he called net-net investing. He would calculate the company's net current asset value, current assets minus total liabilities, and if the market price was less than that figure, he considered the stock to be selling at a deep discount. Imagine this. A company has $100 million in cash, receivables, and inventory, and $60 million in total liabilities. Its net current asset value is $40 million. If its entire market capitalization, the price you'd pay for all its shares, is only $30 million, then an investor is, in Graham's words, buying dollars for 75 cents. That gap was his opportunity. He understood that not every business deserved the full faith of its book value. Some assets might be overvalued or illiquid, but the margin gave room for error. As he famously put it, the essence of investment management is the management of risks, not the management of returns. And so, Graham sought protection first, profit second. He refused to speculate on what a stock might become. He wanted to know what it already was worth. But his genius was not merely in the numbers. It was in the discipline, the temperament to follow those numbers when others could not. When a stock was ignored, unloved, and selling far below its assets, most investors turned away. They wanted excitement, not patience. But Graham saw such moments as his greatest allies. In The Intelligent Investor, he wrote, "The intelligent investor is a realist who sells to optimists and buys from pessimists." To Graham, pessimism was not a warning sign, it was a gift, because it made prices fall below value, creating the very opportunities that rational investors live for. He was, in many ways, an archaeologist of finance, patiently uncovering the truth buried beneath layers of market noise. Each undervalued stock was a fragment of reality mispriced by emotion. And yet, Graham never claimed that book value alone was enough. He warned that it must be supported by earning power, the company's ability to generate consistent profits over time. Because in the end, no matter how attractive the numbers looked, value could only endure if the business itself did. And that insight, that value and vitality must coexist, is what made Graham's method not just analytical, but timeless. But the question remains, does this approach, born in the industrial age, still hold meaning in a world of software, data, and intangible assets? To find out, we must bring Graham's principles into the modern market and see whether his logic still illuminates the truth behind today's prices. Nearly a century has passed since Benjamin Graham first wrote about book value and intrinsic worth. The markets have transformed beyond recognition. Factories have turned into cloud servers, inventories into data, and tangible assets into code. And yet, the underlying principle remains the same, because at its heart, value is not about what an asset looks like, it's about what it produces. It's about the relationship between price and substance, between expectation and evidence.
Many modern investors dismiss book value entirely, arguing that in a world of software and intellectual property, tangible assets no longer define worth. And there is truth to that, partially.
A company like Microsoft or Alphabet doesn't need heavy machinery to generate billions. Their real value lies in algorithms, talent, and network effects, things you can't measure with a balance sheet. But Graham's insight was never confined to accounting figures. He used book value as a compass, not a cage. It was a way to anchor judgment, to ask, what am I actually paying for? Even in today's world, that question is more relevant than ever. When prices soar based on narratives rather than numbers, investors lose their footing. And when corrections come, as they always do, only those with the foundation in reality remain standing. Think of the tech bubble in 2000. Investors poured money into companies that had no earnings, no cash flow, no real assets. Their book value was almost non-existent, and when sentiment shifted, those stocks collapsed overnight. Graham would have seen it coming, not because he could predict the future, but because he refused to abandon the present facts. He taught that the true measure of value is not found in projections or promises, but in what can be demonstrated today. As he put it, you are neither right nor wrong because the crowd disagrees with you. You are right because your data and reasoning are right. That is the eternal relevance of book value. It reminds us to think like owners, not speculators. Even modern investors who follow Graham's lineage, from Warren Buffett to Seth Klarman to Howard Marks, still use his principle, though refined for a new era. They no longer rely on raw book value alone, but on what you might call economic book value, the underlying earning power of the business. In other words, the foundation remains the same, even if the materials have changed. A company that consistently produces cash, maintains financial discipline, and reinvests wisely builds value, whether or not its assets are physical. And when the market price falls below that accumulated strength, the opportunity arises, exactly as Graham described. So while the balance sheet may look different today, the message endures. Know what you own, know what it's worth, and never pay more than reason demands. Because the true purpose of understanding book value is not to chase bargains, but to build conviction, to stay calm when others panic, and skeptical when others are euphoric. And that, as every generation of intelligent investors learns, is how fortunes are preserved. There's a quiet wisdom behind Graham's fascination with book value, one that transcends finance altogether. It's the recognition that value and price are not the same thing. Price is what people shout about in the news, in the markets, on social media. Value, on the other hand, is silent. It exists in the background, steady, real, often ignored, waiting for the world to notice. In many ways, Graham's entire philosophy can be distilled into that single tension, the world's obsession with price versus the investor's devotion to value. He often reminded his students, in the short run, the market is a voting machine, but in the long run, it is a weighing machine. Those few words capture not just the movement of markets, but the rhythm of human behavior. In the short run, people vote with emotion, fear, greed, excitement, despair. But in the long run, reality asserts itself. The truth of value, like gravity, cannot be denied forever.
Booked value, in that sense, is more than a financial metric. It is a philosophical mirror, a way to see through illusion. It forces us to ask, am I buying what's real or what's merely popular? Because popularity is fleeting, reality is patient. And Graham knew that investing was, above all, a test of temperament, a battle between perception and principle. When prices rise too high above book value, excitement replaces analysis. When they fall too low, fear replaces logic. The intelligent investor must resist both. To Graham, the goal was not to predict the crowd's emotion, but to remain immune to it, to find peace in numbers, clarity in fundamentals, and confidence in fact. He believed that financial markets, like life itself, eventually reveal the truth, and that truth favors those who wait, patiently, rationally, and independently. There is something deeply human about that. Because every investor, at some point, must confront the question, do I want to be right, or do I want to agree? Book value, then, becomes a moral compass as much as a financial one, a reminder that substance matters more than surface, that endurance matters more than excitement, and that integrity in analysis is the truest margin of safety there is. When Graham wrote The Intelligent Investor, he wasn't merely teaching how to pick stocks. He was teaching how to think, how to behave, how to remain calm when the world loses its balance. And perhaps that's why his lessons endure, because they speak not only to the mind of the investor, but to the character of the individual. The market, after all, is nothing more than a mirror reflecting human nature. To see value clearly, you must first learn to see yourself clearly, your impulses, your fears, your illusions. That is the true discipline of investing. Not mastering the market, but mastering one's mind. So how does one apply all this in today's markets? A world where algorithms trade millions of times a second, where headlines move prices before reason has time to respond. The answer, as Graham might say, begins with discipline. Start by grounding yourself in book value, not as a rigid rule, but as an anchor of reality. When you analyze a company, ask simple but profound questions. What are its assets truly worth? How much of that worth belongs to shareholders after debts are paid? Is the market valuing this business above or below that tangible foundation? If the stock trades far above book value, be cautious. The market may be pricing in dreams, not facts. If it trades far below, investigate. The market may be overlooking something essential. But most of all, think independently. Graham warned that the danger of markets lies not in volatility itself, but in our reaction to it. When others panic, we must stay calm. When others chase, we must measure. When others follow fashion, we must follow fact. Nearly a century later, the same timeless truth remains. The intelligent investor is not defined by brilliance, but by character. It takes character to ignore noise, character to value what is unpopular, character to wait when the world demands action. And that is what Graham truly taught, that investing wisely is not about predicting tomorrow, but about preparing today. Because the investor who understands value, real, intrinsic, tangible value, no longer fears the crowd. They understand that markets may misprice reality for years, but they never deny it forever. As Graham wrote, the investor's chief problem, and even his worst enemy, is likely to be himself. So let your analysis protect you from emotion. Let your logic protect you from illusion. And let your principles guide you when prices no longer make sense.
When you invest with Graham's lens, comparing book value to market price, seeking value where others see boredom, you are not just investing differently, you are thinking differently. And in the long run, that difference makes all the difference. In every generation, the market gives investors a choice: to follow the crowd or to follow the truth, to trade emotion or to practice discipline, to chase price or to understand value. Benjamin Graham chose truth, discipline, and value. And in doing so, he gave the world not a formula, but a philosophy, a way to see clearly through uncertainty. The next time you study a stock, remember, behind every chart and every ratio lies a simple question:
What is it really worth? Answer that honestly, and you're already walking the path of the intelligent investor. If you found this exploration meaningful, consider subscribing to Benjamin Graham Value Insights. Our mission is to preserve and share the timeless lessons of the father of value investing, lessons that still guide rational investors today. Like this video if you believe in the power of logic over emotion, and share your thoughts below. How do you define value when the market disagrees? Because every thoughtful comment, every rational discussion brings Graham's legacy one step closer to the world he hoped we would build, a world of intelligent investors.